Okay, now that we've looked at the other forms of market structures, now we're going to look at what public companies mean and how the share market works. And this is what we spent most of the time in when we were playing the share market game, looking at some of the key features of public companies. So first things first, there's a couple of key words you need to be aware of. The terms startup capital. So startup capital refers to the money needed to start up a new business. Limited liability, so a person's liability is limited to their investment in the firm. So it basically means if you put $20,000 of your own money into the firm, you can only lose $20,000. You can't be forced to sell off your own private assets or anything like that. So private and public companies have limited liability in that a person can only lose the value of their shares. They can't be forced to sell off their own private assets. A sleeping partner, someone whose name is not mentioned on the business name and is not active in the running of the business, but has made some form of financial contribution. So they put money towards the business, so even though they're not named in the business's name or not actually part of the running of the business, they still have put a financial contribution towards the business. And bankruptcy, that's when a business realises it's unable to pay its debts and they close down and sell off their assets, so that they realise that their business is no longer viable. In terms of the share market, what we're going to look at is what's meant by shares or stocks, why do companies issue shares, what are some of the key features of a public company, how are public companies different to private companies, and what is meant by an initial public offering. So first things first, when you're looking at a public company must have at least 50 shareholders. So the minimum amount of shareholders in a public company is 50, and they receive dividends for having shares in these companies. They don't have to receive dividends, but a lot of public companies will pay out dividends. Shares can be bought and sold by any person or company. So anyone that has shares in a public company can sell them to anybody else who's interested in buying shares in a public company. And they become part owners in that company. They're run by a board of directors. They are listed on the Australian Stock Exchange. So they are listed companies in that anyone can buy and sell shares in them. And they will generally have the words LTD after their name, as opposed to private companies with PTY LTD after their name. So here's some examples of big companies you will have heard of that are public companies like Facebook and Apple and Microsoft. Control of public companies. A public listed company means the shares in that company are available for purchase on a market such as the Australian Securities Exchange. If a person has more than 50% of a company's shares, that person has control of that company. So if you have more than 50% of the shares in a company, then you are said to have control of that company. In terms of some of the advantages and disadvantages of a public company, the advantages include the fact that they have limited liability. So that means that you can only lose the amount that you've invested in that company. You can't be forced to sell off your own assets if the company starts going badly. Owners can raise large sums of capital by issuing shares to the public for sale. So it's easier for those who run public companies to quickly obtain finance, so they can just sell more shares or issue more shares to generate more money for that company. That means there's now more owners of the company, so their ownership stake would be diluted or reduced, but it makes it easier for them to generate more money if they want to grow the size of their business. Another advantage is investors can sell their shares whenever they want to leave the business. So as soon as you decide that you no longer want to be part of that business, you can sell your shares and leave that business. In terms of the disadvantages, there are large setup costs for the business often. They must comply with legal requirements. There's often a lot more strict reporting requirements for public companies. Often your share of the business or your ownership stake or your say in the business is reduced. So investors often only get a say in the AGM. So you often have a lot less power in the running of the business if you make your business public, particularly because you're sort of sharing ownership with a whole range of other people then. So therefore, you aren't the sole owner and therefore the sole contributor of ideas to that business. When you're looking at what is meant by a share or a stock is a unit of ownership in a company. So stocks or shares are issued initially to raise funds for a business, and anybody who buys a share becomes a part owner in that company. And therefore, when the company makes a profit, they will benefit generally in the form of either dividends or making capital gains on their investment. Some businesses become so large they become listed companies with many part owners or shareholders, so you can have over 500,000 shareholders. A publicly listed company means the shares in that company are available for purchase on a market, which in Australia is the Australian Securities Exchange. They are all called listed companies because the original form of trading shares in companies involved the names of the companies being listed on large boards. Shares in publicly listed companies can also be known as stocks, securities, or equities. So a share is a part ownership within a company, and they're used to raise funds for companies. Two other keywords are dividends and capital gains. So dividends are when companies distribute part of their profit to its owners. So they might distribute dividends, which can then be reinvested into buying more shares, but it's when the companies decide to give money to their owners. And capital gains occur when shares increase in value over time. So when investors sell their shares for a higher price than what they bought them for, they are said to have made a capital gain. A stockbroker is someone who buys or sells shares on behalf of clients or investors. So their job is to try and get people to buy shares. They earn a commission every time they get someone to buy a share. So a brokerage fee is also charged by the stockbroking firm. So anytime that you wish to buy or sell shares and they do it on your behalf, you have to pay a brokerage fee for any time you buy or sell a share. And you can buy and sell shares at any time between 10 a.m. and 4 p.m. each weekday, so Monday to Friday. We'll talk about the primary and second markets of shares in the next video.